Hello, live community. It's Jackie Porter, the financial confidant. So, the original pretend DJ, bringing you back this song that I dusted off the crates. How many of you remember this song? This is from my 80s soul diva. So you might want to know what made me decide to do Feel So Real by Patrice Rushen today. Because I had to dig way back for that one. So anyway, for those of you from Gen X or maybe baby boomers who remember this song, definitely post in the chat if you remember that hit, golden hit. I really thought it would be fun to bring out this particular song. It spoke to me because the title of the song, obviously she's talking about how she feels about her paramour, but I was thinking about how real it feels for people right now when it comes to the markets. And, these days looking at your statements might feel so real to you as well, right? I know that's what my clients tell me is just seeing some of the gains that they've lost in their portfolio from January, that seems so long ago, to now, feels so real to them. So my question for you today, live community, is how are you feeling? How are you dealing with all of this market volatility? I would love to know, are you the kind of investor who is checking your statements constantly, avoiding opening up your statements? What kind of investor are you? I would love to know, because I know, as I said, there is so much volatility happening in the markets these days, and there's certainly no shortage of bad news to go around. So I'd love to know, exactly the kind of investor you are, and, how you're dealing with the risks in your portfolio. So that's kind of what I want to focus on today, is discussing risk, because risk is a subject I don't think we talk about enough, and that people overall, investors overall, truly understand, because there are more than one type of risk. So we're going to cover it. We've got you today. If you're someone who is worrying about your portfolio right now, not sure if you should be doing something, that's something clients ask me all the time, or maybe you're thinking, it's time for me to run for the hills. This is the live for you. So please stay tuned, because we're going to cover, exactly what risk means, in case you didn't know. We're going to talk about the different types of risks in the market. And, I think one salient point that we don't talk about enough as advisors is the cost of the so-called no-risk portfolio. What exactly is a no-risk portfolio, and what type of risk does that kind of portfolio pose to you? So we will talk about that. And then finally, we'll delve into ways to help reduce the risk that you might be facing in the current markets. So again, post in the chat, the kind of investor are you? I'd love to know. First of all, are you worrying about the markets? Let us know. We'd love to know how you're feeling, live community. And are you constantly checking your statements, or are you avoiding looking at your statements? Please, please, please send us my information in the chat. We definitely want to get feedback from you and, of course, respond. And finally, if you have questions, and there's no question, remember, this is a safe space for the Confidant community to talk to one another, to talk to me. If you do have questions, please feel free to leave them in the chat. We do respond to our questions. We're always checking our feeds to see how we can be of value to the community that we serve. So let's get started. So I'm going to ask you a question, live community. Speaking of risk, how many of you are familiar with what it means, what market risk means? So I'm going to say it again. How many of you are familiar with the term market risk? What does that mean? So I'm going to give our live community an opportunity to post in the chat. So market risk is actually worrying about whether or not you will see your investments, your current, nest egg, go down in value. And the thing about market risk, it's not one market risk, there are many market risks. So let's talk about that. So what does market risk mean? It's the risk of seeing your investments go down, which unfortunately we are seeing in this market. And truly, as we're talking about safe, there's no safe place to hide these days, right? Like the real estate market's down, the stock market's down, the bond market's down, cash, that's really it. So anyway, market risk, the risk of your money going down based on market factors. And there are 4 types of market factors that we should talk about. The first one is equity risk. And, equity risk is the chance of a stock or mutual fund or ETF going down because of market factors. And there's many, we had a sort of what we call in the industry in 2020, a black swan event. And a black swan event is where a risk to the market comes out of nowhere, like COVID, and caused the market to go down severely in a very, very short period of time. So there's no shortage of market risks. So it's what could happen in the short term or interim that could lead your stock or your equity investments to go down. So stocks, ETFs, mutual funds that invest in stocks to go down. So that's market risk in terms of equities. The other factors, strangely enough, we are dealing with right now, which is interest rate risk. So how many of you can guess how many times interest rates have gone up for 2022? How many times? So what's the number? How many times have interest rates gone up for 2022 so far? So again, I'm going to check on my feed here if anybody has a right answer for that one. Okay, I'm just seeing some of the responses on my feed. Sam, Megan saying, I'm looking at my numbers every day, but that's not like weighing yourself. Oh, that's a good one, Megan. It's not for the faint of heart. Yes, if only we could weigh ourselves every day and see the number go down versus our portfolio go down, right, Megan? I love that. Anyway, we talked about market risk, equity risk, and then we started to talk about interest rate risk. And I wanted to see if anyone knew how many times the market interest rate has gone up in the last, since January. So I'm going to let people guess. I won't tell you yet, but as we can see, we've seen interest rates go up several times. I'm going to see if anybody gets it in the chat. We'll see what people post by the end of our live. But, we have seen interest rates go up quite a few times this year, and we have seen the impact on the markets. Keep in mind, interest rates, it's all about money and the cost of money. So, and the cost of borrowing money. So how cheap is it to borrow? Or how expensive is it to borrow, to get something, to buy something? So for an investor, borrowing to invest, or borrowing to invest to buy a property. Megan, who's our real estate expert, who's on the live, knows about this because she's seen interest rates go up, the cost of buying a property go up, and more people recognizing, like really just taking people out of the markets, just simply because it's more and more expensive to finance a mortgage and finance those mortgage payments. So there's less people in the market, which means less demand, which means home prices go down. So very similar in the stock market. For the real estate market, interest rates are a market risk, but similar in the stock market, the more expensive it is for investors to borrow, for business owners to borrow, that will have an impact on the stock price. That will have an impact on how many people are buying stocks as well. So another risk, interest rate risk. We've talked about equity risk. And then the last two risks we're going to talk about is currency risk. And so wonder if anybody out there know what we're talking about when we talk about currency risk. So currency risk is, let's say you're Canadian, like we are, and you're buying stocks in the US. So now you're buying in Canadian funds, but converting to US dollar. What happens if the cost of your Canadian funds keep going down? So you're buying, US dollars at a more expensive price. What's that going to do to the value of your stocks? Opposite, if the cost of the US dollar is going down, you might be able to buy more shares because you can buy more shares with your Canadian dollars than if the price is going up. So just things to consider. If you are buying investments in foreign currencies, how will the currency price affect the value of the investment that you're buying? That's a currency risk. And then finally, we're going to talk about in terms of risk, commodity risk. And again, yet another factor we are facing in this current market, which is commodity risk. One of the commodity risks we're dealing with is the cost of oil. So you might have probably still have trauma from 2020 when we were all in lockdown, and quite a few of the cartels decided that they would pump less gas because less people were driving, less people were moving around. And so we are currently facing a shortage of oil just because the tap is being turned back on, and we just can't get enough oil out of the ground fast enough, leading to a very big spike in oil prices. So that's kind of what we're dealing with oil. So what will the cost of oil, how does the cost of oil going down or going up, how does that impact the market? Now, you can imagine, oil is literally the engine of the economy. We need it for everything. We need it to ship goods and services to and from all around the world. There's few things. I mean, clearly we're in a stage where we're moving, albeit ever so slowly, we're moving towards alternative energy, but the truth is we're not there yet. And so we have this confluence of events, not enough oil coming out of the ground, impacting the cost of goods, impacting the actual markets. And unfortunately, having all that happen at a time when we have one of the major oil producers, Russia, getting into a war with the Ukraine. So yet another perfect storm of events happening where the cost of oil is skyrocketing, impacting, again, business owners, investors, consumers, in terms of oil prices, and impacting the market currently in a pretty profound way, leading to, again, more volatility in the markets as a whole. So far we have covered, just to make sure everybody's with me, we've talked about equity risk, we've talked about interest rate risk, we've talked about currency risk, and we've talked about commodity risk. So those are some risks in the market that, if you're not quite sure at the moment how your portfolio is sort of aligned or structured to deal with some of these risks, it's a good idea to talk to your advisor about that. Now, let's talk about some ways to reduce risk, because I think that people just assume that maybe when they heard about Bitcoin as a place to make money, because the thing about making money, it's great to make money. Typically, we have a saying in the investment world, which is, if you're prepared to take more risk, you could potentially experience more reward. right? So depending on the type of investor you are, and that's when it really is important for you to think through what can you stomach in terms of a loss in the short term. If you're looking at your statements and you're losing sleep over 10%, seeing your portfolio go down 10%, can you afford to take less risk? So these are some of the questions and the conversations you should be having with your advisor is basically looking at, how much risk for the opportunity of reward am I willing to take in the short term? Ask yourself that question. That's what that, potentially not so exciting risk tolerance questionnaire that we get you to fill out as advisors before we start talking to you about investment products. I've seen a really interesting question come through from Megan, and she said, for people who don't think they own stocks, so currency risk isn't applicable, I love this, your shopping basket has both commodity and currency risks when you buy a foreign-made product. What are some other ways this is impacting even people who don't have investments yet? That's a really good question, Megan. We'll talk a little bit more about this maybe offline, but I think this is a fair question to ask is shopping basket. So, we're seeing inflation, the cost of goods, and we're going to talk about that as another risk. So I think this is a good time. Actually, before I delve into some ways to reduce risk, I'm going to talk about inflation because that's one of the things that another risk that you face when it comes to the market is really the price, the cost of things going up, and that could be in the goods and services, like some of the things that Megan is talking about. So we can see with inflation, our goods and services basket. So the cost of bread, the cost of oil, the cost of just groceries, right? So all the things that we buy every day, clothing, and I know a lot of my clients, myself included, have had sticker shock when we've gone into the grocery store, bought gas, bought the things that we need, just the food basket, the regular food basket, and recognizing all of those things are costing that much more. So it's how much less will your money be worth to keep up with inflation in the future? That's another thing to talk to your advisor about. How is my portfolio structured, especially for the more conservative investors? How is my portfolio structured to deal with the rising cost of living? Because that's what inflation's about. It's the cost of living is going up. Is my investment going up to keep up with the cost of inflation? Because it is a risk to your portfolio. And that is going to lead me to talk about really what the no risk, is there such thing as a no risk portfolio? Because again, I'm finding that in this market, people are running for the hills. And I think it's important to talk about, why there's a couple of risks that you need to be aware of. One, as we talked about, is will your money keep up with inflation? Will your money keep up with the cost of living? And then if you're investing in something like a risk-free, which is it really risk-free if it doesn't keep up with inflation? So I know that, clients are asking me about GICs once again. So potentially, let's say you buy a GIC, for $10,000 and it promises you a 3% rate of return. So you're getting a little bit of income, which might be fine. However, as time goes on, again, speaking of inflation, your $10,000 over 5 years is only maybe $11,000 after 5 years. And so $11,000, you started off with 10, you've made $1,000. What is inflation? So how much has the cost of living gone up? So you kind of think to yourself, here's my $10,000. It's not volatile. It's not doing this in the stock market. But then as you get closer to that 5 years, you might start to panic because you're realizing, oh, this is actually a risk. my money didn't go up very much. It feels good for it to not go up very much in the short term or go down. But when you get to the end of a time frame and you think, okay, now it's my investment's only worth $1,000 more, which generates a very low interest, and the cost of living has gone up. I mean, right now we're battling very, very high inflation, a much, much higher inflation than we've battled over the last 30 years. And so it's just important for you to think through, is my investments worth almost the same as what I started with in a GIC? Does that pose a risk that if my money did not grow, but the cost of living has gone up significantly, will my money be worth enough, or will it run out that much sooner so that I won't have how much I need for my retirement, which means I might have a scenario where I have less money in retirement and my money might run out before I do. So that's really the risk of a risk free, quote unquote, free portfolio, is that if you're in a scenario where your investment is not generating enough income to keep up with inflation, you might run into the risk of running out of money sooner than you plan to. And then you couple that with taxes. So for those of you who are holding things like GICs that might not keep up with inflation, so GICs and short-term investments outside of an RSP or TFSA, tax shelters, consider that whatever interest you earn, GICs produce something the government calls accrual interest. Did you guys hear that? Accrual interest, which means as you earn it, as it's accrued, you have to pay taxes on it. So I want you to think about that. Accrual interest. As you earn interest, you have to pay taxes on that. I consider that accrual a very terrible way to earn an income, because basically you can consider whatever you've made. So let's say you've earned $300 on your investment. You've earned an interest rate of 3%. That works out to $300. At the end of the year, the government is going to provide you with this tax slip that says you've earned $300, and you have to pay taxes on that $300 at your personal tax rate. Because 100% of the interest is going to be added to your income tax, because it's 100% taxable outside of an RSP or TFSA. So if you factor in the after-tax income that you've earned, now you're really potentially not keeping up with inflation. So consider, is the interest investment keeping up with inflation? Remember, outside of an RSP or outside of a TFSA, it's 100% taxable, not like capital gains. That's only 50% taxable, or dividend income, which is only 66 and 2/3% taxable. That's the amount you have to pay. You have to report on your income tax. Interest-based investments, accrual interest, are 100% taxable. So you factor in those two factors. Is that investment truly risk-free? And will it mean that between the income that you're not earning because it's not keeping up with inflation and the taxes that you have to pay, which erode your after-tax return even more, will that truly be a risk-free investment to you? Or will you be at risk of losing money? So consider how your portfolio, if you're holding investments out of your out of your tax sheltered accounts, again, have a conversation with your advisor on what is the place in my portfolio. Is there a place in my portfolio for GICs? How can I structure them in a way so I pay as little tax as possible? Will I grow my money enough so that I won't run out of money in my retirement? Do I have a financial plan that speaks to all of this? And then speaking of risks, and speaking of GICs, the final risk I'm going to talk about is liquidity risk. So again, going back to the fact that no investments are risk-free, and the investments that you choose have everything to do with your risk tolerance, your time horizon. Those are two crucial factors to consider when you're making investment decisions: is what's my risk tolerance? How do I feel about losing money in the short term? What will make me derail my financial plans, derail my investment plans? What type of a loss will make me do that? Will make me maybe cash out and start to lose money? These are things to seriously consider when you're making an investment. And then, if you're buying investments for the short term, a GIC might be fine if it's a short-term investment, because again, the last risk I'm going to talk about is liquidity risk, and liquidity risk has everything to do with how easy is it for me to cash that money in if I need it for an emergency. So if I need money for an emergency, is my investment available to me to be used? Sometimes clients don't know when they buy GICs, there are redeemable GICs and there's non-redeemable GICs. If you hold a GIC, do you know what type of GIC you have? Do you have a redeemable GIC or a non-redeemable GIC? Because if you're using that money for short-term purposes, so matching risk tolerance with time horizon. So maybe I've set up this GIC, just for emergencies. If I need it over the next, 1 to 3 years, then having it in a non-redeemable GIC may not make sense, because for that emergency, you will not be able to redeem the money. You're going to have to wait till the end of the term before that money is cashable. So these are some things to look at when you look at the type of investment that you're holding. Do I have liquidity risk? Do I need the money? Because cash is king, especially in a time like this where you might have high interest debt that you're trying to pay off, because your inflation costs and your interest costs have gone up and you just don't have that extra cash and you don't want to go into more debt. Is that GIC that you might hold for emergencies redeemable or cashable or non-redeemable? Because liquidity is a risk, cash is king, and it might mean that you have a fewer options in this case. So now I'm going to tell you about some ways to reduce risk in your portfolio. And I see Jody has already posted that if you're having questions about your financial circumstances, if this if this live has sparked questions about your investment portfolio and you're looking for advice, please reach out to us. Please reach out to our team. Jody has posted in the chat ways to get in touch with us for a 30-minute strategy session. So definitely check that out. One of the ways to reduce risk in your portfolio is match your time horizon with your risk tolerance. Make sure that you're buying investments that also you're not going to derail your investment plan based on not being comfortable with short-term loss. So match your risk with your time horizon, buy investments based on your comfort level with loss. These are the two big strategies. And then, of course, diversification. So how many of you have a diversified portfolio? Do you know what is a diversified portfolio? It's holding investments that don't look the same. You don't have all your eggs in one basket. So you might have stocks, bonds, you're holding different types of stocks in different industries, different asset classes. Maybe you're holding global investments, you're holding Canadian investments, you're holding some commodities. Your investments are different asset classes in different countries, just to make sure that, if we have a market risk in one area of the market, so currency risk, all of your investments aren't all in US dollars or all in Canadian dollars, or you don't have all your investments in one industry or one sector like resources. You're not all in tech if the tech market goes down. So having your investments in different baskets give you some protection, reduces some of the short-term loss in your portfolio, and overall reduces risk. So that's one strategy. The other strategy is buying making monthly contributions to an investment, especially in a market like this. Is if you're thinking, I need to make my RSP contribution, how do I do that? You can make monthly contributions to your RSP. And then that way you're taking advantage of all of the ups and downs in the market. You're not buying the market on one price and in one day. And then the other thing to consider is, as I said, we talked a little bit about not losing money, at least being comfortable with the short-term loss that you're facing, understanding the kind of investor you are. And there are different types of investors. There's people who are comfortable being more conservative, not wanting to take a lot of loss. You need to know if you're that type of investor. If maybe you're only comfortable with maybe a 5% drop in the markets or a 7% drop, really go carefully through those questions with the risk tolerance questionnaire with your investment advisor. You might be a balanced investor who wants to see your money go up, grow, but also wants to have some of your money in investments that produce income, like dividends or bonds or little bit of GICs. Again, what type of investor are you? Do you know? Are you an aggressive investor who is comfortable with all of the swings happening in the market now? I have clients calling me saying they want to put more money in the markets because they are very much focused on the long term. They're not retiring for quite a few years and they want to grow their money as much as possible. So identifying the type of investor you are, identifying how comfortable you are with short-term loss, making sure you're diversified are definitely ways to reduce risk in your portfolio, because ultimately the biggest risk you face is not sticking to your plan. So especially when the markets become rough like they've been, and you get in your feelings, and then you decide you want to take your money out on one day and cash in and decide to come back and maybe make a decision later to come back in the markets. That's a surefire way to add risk to your portfolio and potentially lose the ability to grow your wealth over the long term. So if you're facing these kinds of challenges, emotional, and you need to talk through your feelings, you need to taken off a ledge, you need to have a rational conversation, because making rational decisions is the most important thing you can do as an investor. Not emotional decision, but rational decisions, which is looking at, what's the track record of the investments I'm in? How have they done over time? Am I comfortable making additional deposits into those plans? Because making additional deposits in the plans when the market is down might also reduce your costs per unit if you're more of an aggressive investor. So these are just some things to talk through with your advisor. The key is, do you have an advisor? Do you have somebody you feel comfortable with, that you trust, to go through these investment questions with you? Reach out to us, reach out to our team, reach out to your trusted advisor, and thank you again for tuning into this live. Feel free to share this video if you found this information useful, and definitely stay in touch with us for all the latest updates. Thanks everyone for tuning into the live today, and we're going to be in a whole new month next month. Next month, we're going to talk all things retirement, so definitely stay tuned for those updates as well. See you next time. Bye everyone. Bye live community. Bye Confidant community. See you soon.